There's a most we inherit without questioning it. Parents repeat it, grandparents believe it, real estate agents market it everywhere. Rent is throwing money away. Buying a home is the smartest financial decision you will ever make. It sounds so obvious that we stop questioning whether it is actually true. Many people feel shame when they are still renting in their late 20s or 30s, as if adulthood requires ownership, as if renting means failure. So people rush into buying homes they can barely afford, stretching their finances simply because society says owning equals success. But in today's economic reality, this script is no longer universally true. For millions of people, the math has changed. And the uncomfortable reality is this: your house might not be an asset, it might be a liability disguised as an investment. Welcome to Mike Invest, where we break down money using real numbers instead of cultural myths. Today, we are going to dismantle the rent versus buy myth, expose unrecoverable costs of homeownership, explain the price to rent ratio, and show how renters who invest strategically can sometimes outperform homeowners financially. When renters pay monthly rent, everyone agrees the money is gone. But homeowners are told their payments build wealth. That is only partially true, because homeowners also pay large amounts of money that never come back. These are called unrecoverable costs. In the early years of a 30-year mortgage, around 70 to 80% of your payment goes toward interest. You're not paying yourself, you are effectively renting money from the bank. Property taxes function like permanent rent paid to the government. They never build equity, they never stop. A common rule suggests 1 to 2% of a home's value must be spent annually on maintenance, not luxury renovations, basic survival costs, roofs, plumbing, heating systems, unexpected repairs. Home insurance is mandatory. Buying and selling costs can reach up to 10% of the property value. That money disappears instantly. When you combine interest, taxes, maintenance, insurance, and transaction fees, the unrecoverable cost of owning can rival or exceed renting. You're not eliminating rent, you're simply paying different landlords: the bank, the government, and the repair industry. The key metric is the price to rent ratio. Price of home divided by annual rent for a similar property. Below 15, buying often makes sense. Above 20, renting frequently becomes financially smarter. Many major cities now sit above 25 or even 30. When ratios are high, renting allows you to live in an expensive asset at a fraction of ownership cost. The landlord absorbs risks, repairs, market fluctuations, unexpected failures. The down payment is often overlooked. A $100,000 down payment becomes locked inside one illiquid asset. It generates no direct cash flow and cannot easily be rebalanced. Historically, diversified stock markets have produced higher long-term returns than residential real estate in many periods. By locking capital into one property, you are betting heavily on a single local market. Renting while investing: the difference between renting and owning costs can accelerate wealth accumulation. You gain liquidity, diversification, and flexibility. Renters can relocate quickly for better opportunities. Homeowners face high transaction costs and time delays. Buying a home can unintentionally reduce career flexibility. In a rapidly changing economy, optionality is valuable. Flexibility itself is a financial asset. Yes, fixed mortgages hedge against inflation, but other costs continue rising: taxes, insurance, maintenance. Ownership is not immune to inflation. While rent increases over time, investment portfolios historically grow as well. If investments outpace rent inflation, renters can gain financial advantage. Homeownership requires time and mental energy. Repairs, maintenance, planning all demand attention. Renting outsources these responsibilities. Renting buys time. Time can be invested into skills, career growth, relationships, or rest. Buying works best when you plan to stay long-term, you value customization, and local ratios favor ownership. Buying should never be driven by social pressure or fear. Only math and personal priorities should decide. Treating your primary residence as your main investment creates concentration risk. Illiquid, location-dependent, hard to diversify. True wealth comes from income-producing assets: stocks, bonds, businesses. A house provides shelter, not guaranteed financial freedom. Do not let cultural expectations dictate financial decisions. Run the numbers, understand the ratios, analyze the unrecoverable costs. If the math says rent, rent confidently. Invest the difference. Build liquid assets. This is Mike Invest. Subscribe for clear, honest financial breakdowns.